This is a podcast from the Business Times.
A tech-powered and geopolitical relief rally boosted U.S. stocks yesterday, while crude prices dropped as supertankers sailed through the reopened Strait of Hormuz, hours after U.S. President Donald Trump signed a peace deal with Iran. U.S. markets are closed today in observance of Juneteenth. Investors processed Middle East developments and a hawkish pivot from the Warsh Fed. But what about Japan's normalization strategy, Singapore's stagflationary pressure, and inflation for all? Lots to cover. Welcome back to Market Focus Weekly. I'm Howie Lim. It's Friday, June 19th, 2026. I'm joined by Pete Tan, Portfolio Manager at PhillipCapital. Always good to speak.
Thanks for having me back.
Let's start with the Fed policy shift as Fed Chair Kevin Warsh effectively strips forward guidance and emphasizes productivity. Do you think markets have adequately priced in the volatility, Pete, of a fully live FOMC? Or do you think this hawkish flexibility is being misinterpreted as a return to more traditional data dependency?
Yeah, so I think there will be likely more volatility to come because a fully live FOMC just means that every data point in terms of inflation, growth, and jobs will trigger a policy shift, right? So in the past, unlike the traditional way where the Fed operates, we are able to see what the Fed is going to do in advance, right? But right now, the new Fed chair is basically reducing this signal around the process. So it will make the Fed far less predictable.
Okay, I'm going to put your foot to the ground. Back in episode 39 of this podcast series, you said
Yes.
that the worst is over, you thought. And we did
Mhm.
see a geopolitical relief rally following
Yes.
the US and Iran MOU signing. Do you think there's a sustainable ceiling for energy importers like Japan and Korea? And at what point does the relief rally, based on lower oil prices, collide with the reality of just higher costs of capital, really?
Yeah, I think the energy security is a much harder constraint right now. I do think the relief rally still have some legs, right? And that's because of the productivity that's brought about by AI and related manufacturing expansion involving like data centers. So all these will require reliable, scalable power, right? So I think for a lot of these government, they will need to really enhance their infrastructure in terms of grid and energy generation in order to curb this inflation that's brought about by the whole AI investment. But otherwise, I really lean towards still back to my original understanding that I think the stock market has more room to grow given this whole productivity that's driven by AI development.
And the resilient US dollar, what do you make of it?
Yeah, I think US dollar is likely going to strengthen further given that, now everything is more stable and that might have a little bit of a drag on the US market, the US P&L, right? The earnings are all driven in US dollars. So that might weaken the earnings, right? Which is contrary to what a lot of people believe. They say that, the stronger US dollar is good, but actually not really because a lot of these businesses does get their earnings from overseas. However, I think it is not going to be a big problem because we have seen much stronger US dollars in the past, right? So I think this might just be more noise than actually signal.
Let's head to Japan now, though. How do we reconcile the BOJ's decision on Tuesday to hike rates to a 31-year high while simultaneously maintaining a cautious stance on balance sheet tapering? Is this a sustainable balance normalization, or does it risk falling behind the curve?
Yeah, so I think Japan right now is trying to have a measured form of normalization because they had so many years of ultra low interest rate, right? So they are using their policy rate to fight inflation at the same time, supporting the Japanese yen. But they need to be very careful in handling their balance sheet to avoid destabilizing the bond. So I think this balanced approach should work, but that is only if the inflation behaves broadly as expected, right? But if the imported inflation in Japan continues and if the wage gains holds up, then BOJ will look like they are falling behind the curve. So I think the real risk here is in the sequencing of it, right? But I think by and large, the market has kind of accepted this gradual approach. It's not seen as anything that's too dramatic, right? They think that BOJ is likely to hike the rate symbolically, but they will not drain the liquidity because the bond market is a significant part of the Japan market. If they do that, then the confidence will crack from there.
And if global inflation proves stickier, then they fall behind the curve, is what you're saying.
Yes, correct.
In East Asia still, what about China? They're presenting a weird narrative. There's slumping domestic consumption
Yeah.
versus record-breaking export production growth.
Mm.
So as an investor, which of these signals would provide a more reliable indicator?
Yeah. So I think for the rest of Asia, definitely we'll still look at the Chinese export and production numbers. These are the most crucial near-term signals. China being a global manufacturing engine and superpower, right? This will continue to drive their production. But on the other hand, like what you mentioned, there's a slump in domestic retail demand from the data that we saw, right? So it shows that kind of running in the what we call a two-speed economy, right? That the production is high, but the local household remain cautious, and the domestic confidence is not quite there yet. So I think its industrial strength will keep supporting regional trade, which is what the rest of Asia will focus on. But we also need to look out for weak consumer demand. That is a warning sign for businesses that's domestically exposed.
Thanks for not using the fancy term that everyone is using, economic bifurcation. Pete Tan is portfolio manager at PhillipCapital. More in a moment. Stay with us.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. Pete, what about the ASEAN energy paradox with the IEA projecting that Southeast Asia's energy import bill could double by 2050? How's this widening structural investment gap in green power reconcile with the region's aggressive manufacturing and digital economy growth targets?
Yeah, I think it is also largely driven by all the demands of AI, right? That the energy demand is much higher right now, and
But
and
there's
I think
also the
yeah,
energy security.
yeah, that's right. And I think in terms of green energy is still not catching up, at like the traditional power, and definitely we need to look at this investment gap is no longer just a climate thing. We really need to look at all round energy solution. So I think for the ASEAN economy, the growth thesis still hold, but we need to really build up like the grid, just like what I mentioned earlier on, build up the grid, the infrastructure, even if it's not the most green power that we have, right? We can also look at nuclear, which Singapore exploring as well, so that we will not be really falling behind and causing power security to be a bottleneck in terms of development.
Mm. So there is a primary bottleneck, energy
It is, it
security.
is, it
Yeah.
is. And that's because there's a lot of focus on green energy, right? But we know that green energy is unreliable, it's seasonal, it depends on the weather. So very much you can see from this time round during the crisis in Hormuz, right? You realize that actually we are still very much depending on fossil fuel.
Yeah.
So it is something that we cannot escape from. We probably just have to have a stronger mix of energy supply from fossil fuel. Green energy is part of it. Nuclear can play a very big role since it's very clean and very stable. But we need to move fast, right? Otherwise, it can be a bottleneck in terms of our growth.
Yeah. I want to talk about Singapore's stagflationary pressures. Singaporean economists are simultaneously raising inflation projections and also lowering growth forecasts. Do you think this combination will influence the likelihood of an MAS policy shift, especially given the
Yeah.
contrasting regional trends?
Yeah, I think the combination of rising inflation and slowing growth rate will definitely raise the bar for any easing move by the MAS, right? So for Singapore, MAS uses a exchange rate framework to kind of manage the inflation and the interest rate. So this becomes really vital when the external cost pressures are very uncertain. So I think even though that economic growth have softened enough to argue for a against a further tightening, but I think inflation right now is still on the high side, right? So I don't think it's going to be easy for MAS to kind of loosen the grip here. So for anyone that is, now investing locally and managing their mortgage rates or interest rate, right? I think the clear takeaway from the June where they tightened slightly is that policy is likely to stay firm rather than easing. Yeah.
Mhm. Speaking of inflation, the US economy's unexpected resilience and the new chair's emphasis on productivity might have an impact, I don't know, on inflationary pressure of massive AI infrastructure spending. Is there a
Mhm.
risk that investment creates a new source of price stickiness?
Yeah, I think in the short term, yes, there are some risks of this inflation being sticky because it is very resource intensive, it draws on power, and the cost of everything just goes up because of that. So I think
Yeah.
short term, yes, there will be price stickiness, and that's what the new Fed chair has emphasized on, right? In his latest speech just 2 days ago, he mentioned price stability a couple of times, right? In his new statement that was already truncated. So you can see how much emphasis he has on inflation rather than unemployment, which is the dual mandate for the Fed chair, right? So I think he is going to focus on making sure inflation is his primary task right now. And I think it's going to be a complicated path for them to go back to 2%, right? They have to accept that AI is structurally more positive, causing a bit of inflation. But going back to 2%, that would also mean that they really need to do something quite drastic, which I'm not sure if the US economy is able to absorb at this point in time.
Yeah, so it's that tricky balance that they have to strike, right?
Yes, that's right.
Yeah, people didn't want to talk about SpaceX with me, but I just feel like I want to ask. The massive debut of SpaceX vaulted into the ranks of the world's most valuable companies. But this is in stark contrast to broader concerns about tightening liquidity. What do you reckon, Pete?
Yeah, I see SpaceX is more like an outlier than the broader market, right? Because
Mm,
there was a lot of anticipation leading up to SpaceX IPO. There was so much hype going into it. So yes, when it first started, there was a lot of funds flowing into it. It was like a risk-on situation for them. But looking at the valuation, it is about, if I'm not wrong, 100 times of the yearly sales. That's how high it was IPOing. So whether will it hold is hard to say, but such high valuations seldom last very long. And we have seen that in the last few days, actually, SpaceX have retreated quite a fair bit to below 200 per share, right? So I think the conclusion here I have is that this does not give us an indication of the broader liquidity, but it's also to show us that the liquidity is there. It's just that they are very selective. They still believe in a good story, right? A longer duration investment. So they are being very selective rather than easy, as what some people might say, SpaceX just shows that the market is very highly liquid right now, which is actually not true. Yeah.
you've given us lots to think about, Pete. Thank you so much for your insights today.
Thank you, Howie.
Pete Tan, Portfolio Manager at PhillipCapital. That's it for this week's Market Focus Weekly. We'll be keeping a close watch on what happens next. And if you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. I'm Howie Lim. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.